For anyone planning for the future, there's always that one question that just hangs over everything. How much is enough? For decades, we thought we had a pretty simple, comforting answer. But what if that answer is now just dangerously wrong? All right, let's get into it.
It really is the ultimate financial puzzle, isn't it? We save, we invest, we try to do all the right things, but we're all aiming for a specific target. The big question is, are we even aiming at the right one? I mean, think about it. This one number pretty much dictates decades of our life.
And look, this isn't just some abstract theoretical debate. This is a real question from a real person on Reddit just trying to figure out what to do next. It just perfectly captures the confusion. You hit your goal, you've saved all this money, now what? And the classic advice has always centered on one famous rule.
And here it is, the legend itself, the 4% rule. For a generation, this was the absolute bedrock of retirement planning. The idea was so simple. You withdraw 4% of your portfolio in your first year, then you give yourself a little raise each year to keep up with inflation, and boom, you'd be set for 30 years. Simple, elegant, and you know what? For a long time, it actually worked.
But here's the thing, to really understand why it might not work anymore, we have to kind of jump in a time machine and go back to where it all started, a financial world that looks very different from today.
So let's give credit where credit is due. A financial planner named William Bengen came up with this back in 1994. He dug into all the historical data, stress-tested different strategies, and his work gave retirees a clear, data-backed starting point for the very first time. It was a game changer.
But you have to remember, his model was built for the economy of the 90s, and that world was just a different beast. You had much higher bond yields, around 6 or 7%, giving you a safe and steady income. Inflation was pretty calm, pretty predictable. People, frankly, had shorter life expectancies, so you really only needed your money to last about 30 years. And the whole thing was based on a classic, simple 50-50 portfolio of stocks and bonds. That was the world the 4% rule was born into. But that world is long gone, and that brings us to the most crucial point of this whole explainer. The game has completely changed. Seriously, the financial world we live in right now is almost unrecognizable compared to the 1990s. The old maps just don't lead to the same places anymore, and relying on them could get you seriously lost. So what's so different? Well, for starters, inflation has been sticky and way less predictable, which just eats away at your savings. We're also living a lot longer, which is great, but it means our money has to last longer, maybe 35, 40, or even more years. And the markets themselves are just a wilder ride, way more volatile and super concentrated, with just a handful of big tech stocks driving most of the returns. So with all these new challenges, what's the new magic number? Well, according to a major 2024 study from Morningstar, the safe withdrawal rate for today's world is a lot closer to 3.3%. Yeah, a pretty big drop from 4%. And if you think that doesn't sound like a huge deal, check this out. For someone with $1 million portfolio, that's not a tiny adjustment. That's your annual income dropping from $40,000 to $33,000. That's $7,000 gone every single year. For a lot of folks, that's the difference between comfort and real financial stress. Okay, so if the old, static, one-size-fits-all rule is broken, are we just lost? Not at all. The answer isn't a new number. It's a whole new approach. It's about being dynamic. This is how you build a plan that can actually handle the real world. And this slide really breaks it down. The old way was rigid. You took out the same chunk of money whether the market was soaring or crashing. The new way is all about being flexible. It adapts. You might take a little more when times are good, but, and this is so important, you tighten your belt in the bad years. Why? So you're not forced to sell your investments when they're at their lowest prices. That's a killer. So how do you actually do this? Well, one data-backed strategy uses a tool called the 12-month Simple Moving Average, or SMA. The easiest way to think about it is this. It just looks at the stock market's trend over the past year. If the trend is generally up, you stay in stocks and capture that growth. But if the trend starts pointing down, it's a signal to move your money into the safety of bonds before a big downturn hits. It's a system for playing offense when you can and defense when you have to. And if you need proof that this works, just look at these numbers. This is where it gets crazy. If you tried to withdraw a more aggressive 5% a year, a traditional portfolio had a 72% success rate over 30 years. Not bad. But the dynamic SMA portfolio, It had a 96% success rate. I mean, come on, that's a massive, massive improvement in your security. That's the difference between hoping your plan works and being pretty darn confident it will. Now, another really popular dynamic approach you hear about all the time is the bucket strategy. The logic here is super intuitive. You basically just divide your money into 3 buckets. Your first bucket is for immediate needs, 1 or 2 years of living expenses, sitting in cash or a high-yield savings account where it's totally safe. The second bucket is for the medium term, maybe 3 to 5 years out, in safer stuff like bonds. And only the third bucket, your long-term money, is invested for growth in the stock market. Simple, right? So what's the big takeaway here? It's that we have to stop looking for one single magic rule that works for everybody. It's about moving from a universal rule to a personalized, flexible strategy. It's your plan with your rules. I love this quote from Strategic Wealth Partners because it just nails the new way of thinking. Your retirement plan can't be some formula you calculate once and then stick in a drawer. It has to be a living thing, a living strategy that can breathe and adapt to whatever the world throws at it. So what does this living strategy actually look like in the real world? Well, it boils down to a few key ideas. First, you have to be flexible, be willing to spend a bit less after a down year. Second, use guardrails, basically preset rules that tell you when it's okay to spend more and when you absolutely need to pull back. Third, try to cover your non-negotiable expenses, like housing and food, with guaranteed income. And finally, and this one is so important, always plan for healthcare costs to go up faster than anything else, because they probably will. So, in the end, that retirement number that we all get so obsessed with, it's not a finish line that you cross and then everything's over. It's more like a compass that helps you navigate a really long journey. The 4% rule was a great compass for a different map and a different era. So now you have to ask yourself, is my compass pointing in the right direction for the world we actually live in today?